Hello dear learners, welcome again. In this video, I'm going to discuss very important topic, that is national income and concepts or different variants of national income. So let us start with the topic. First of all, the concepts of national income. What do you mean by national income? The first important concept or variant of national income is GDP, that is gross domestic product. Gross domestic product is defined as an aggregate measure of production equal to the sum of the gross values added of all resident institutional units engaged in production. So this is the gross value of this. I'll show here. This is the gross value added by all resident institutional units, right? And the value added, this value added is calculated as value of output, this value of output minus intermediate consumption. You have to deduct intermediate consumption from the total value of output. You will get value added. So this value added by each producing enterprise in the economy taken together is known as gross value added at market price, or in short it is known as GVAMP, that is market price. So if you sum or add all the gross value added at market price by all producing unit in the country, you will get GDPMP, that is gross domestic product at market price. You can see here summation of all gross value added at market price equals to GDPMP. So this is the concept of first or basic concept of national income, that is gross domestic product. Moving on to the next concept, this GDPMP we have already discussed. Next is GDPFC. Here FC is factor cost, means this FC factor cost. How to calculate GDP at factor cost? This is the second concept here. First is GDPMP, we have done already. How to calculate it? We have already calculated GDPMP. We have to simply deduct NIT, that is net indirect taxes. GDPMP minus NIT. What is NIT? This NIT is nothing but indirect taxes minus subsidies. So you will arrive at this NIT. So deduct NIT from GDPMP, you will get GDP at factor cost. That means the payment made to all the factors of production that is added here. The next concept is, third one is GDPMP. That is GNPMP, that is gross national product at market price. To calculate GNPMP, you have to simply add net factor income from abroad, NFIA. So GDPMP add NFIA, you will get this GNPMP, or gross national product at market price. This is the third variant or concept of national income. Fourth one is GNPFC. As we have calculated GDPFC, in the same way we can calculate GNPFC. So third one and this is fourth one. GNPFC, to calculate this you need to simply deduct net indirect taxes from GNPMP. GNPMP we have already calculated here. So write GNPMP minus net indirect taxes. Net indirect taxes we have seen how it is calculated. You will get the GNP-FC or gross national product at factor cost. This is the fourth concept of national income. Fifth one is NDPMP, that is net domestic product at market price. So to get the net value, you have to simply deduct depreciation from the gross value. So there is a simple rule to calculate net value of any national income variant. You need to deduct depreciation. So that's what I have done here. GDPMP, that is gross domestic product at market price, and minus D, that is depreciation. That is, what is depreciation? The wearing and tearing of the equipment and machineries used during production process. So that we need to deduct here to arrive at the net value. So net domestic product at market price can be calculated in this simple manner. So this is the fifth variant. The sixth variant is NDPFC, net domestic product at factor cost. So here simply you need to deduct net indirect taxes from NDPMP, which we have already calculated. So write NDPMP minus NIT. So you will get NDPFC or net domestic product at factor cost. So this is sixth variant. The seventh variant is net national product at market price. So to arrive at net national product at market price, we simply deduct depreciation. As I have told you, to get the net value, simply deduct depreciation from the gross value. So take this similar concept, that is GNP, gross national product, and this is net national product. So only difference is this N, here we have G, that is gross value. So to get the net value, deduct depreciation from the gross value. So GNPMP minus depreciation, we will get net national product at market price. And the next variant is NNPFC, that is net national product at factor cost. This is also known as national income. So to get NNPFC, deduct depreciation from GNPFC. GNPFC we have already calculated here. So GNPFC minus depreciation, you will get NNPFC, that is net national product at factor cost, or NI, this is national income. Or we can also calculate it by deducting net indirect taxes from NNPMP. So both the ways we can use it. So here there is three simple rule to calculate different variants of national income. See, this is the base variant, that is GDPMP. We have three important concepts, that is NIT, which we have seen, net indirect taxes. The second one is depreciation, and third one is NFIA, net factor income from abroad. So what is the simple rule? Simple rule is to get the national concept, that is GNP, from domestic value you convert into national value by adding net factor income. To get the net value from gross value, deduct depreciation, and to calculate values at factor cost, deduct NIT from market price. So these three concepts are there which you must know before calculating the concepts of national income. So these are the different concepts. Now in detail we will see the net factor income from abroad. What is this? What are the different components in this? So net factor income from abroad is nothing but difference between factor income earned by normal residents of a country, say for example Indians working abroad, and the factor income earned by non-residents, that is foreigners working in India, that is in the domestic territory of a country, that is India. So it is the difference of, simple, you can calculate NFIA is equal to factor income earned from abroad by resident, that is Indians working abroad, minus the factor income earned by non-resident, that is foreigners in India. So this difference will give you net factor income from abroad. So what are the components? There are three main components of net factor income. The first one is net compensation of employees, that is wages and salaries earned by the residents working abroad, say Indians working abroad and getting wages and salaries. So to get the net value, you have to deduct the income earned by foreigners in India and the income earned by Indians abroad. You will get net compensation of employees. The second component is net income from property and entrepreneurship. So you can earn income from your property as rent, from your capital, that is interest, and from entrepreneurship, that is profit. So net income, here also you need to find out net. Indians earning rent, interest, profit abroad, and foreigners earning the same thing in India will be deducted, and you will get the net income from property and entrepreneurship. And third component is net retained earnings of resident companies abroad. Here also we will apply the same formula and calculate. So these three are the important components of net factor income from abroad. Now let us take a simple example to calculate different variants of national income. So this is the given values. GDPMP is given as 7,000, receipts of factor income from rest of the world 450 crores, and payments of factor income to the rest of the world 225 crores, and depreciation 770 crore, indirect taxes 1500 crores, and subsidies 245 crores. So these are the values given here. These are the values given. So keep in mind these values. To calculate different variants of national income, you need these values. So this is the given value. Now let us see how we can calculate different variants of national income. So first one is GDPMP, which is given, that is 7,000 crores. The first one is GDPFC. So GDPFC, what we have seen in the previous slides, you need to take GDPMP, that is 7,000, minus indirect taxes, that is 1,500, plus subsidies. So if you calculate, you will get 5,745 crore as GDPFC. Similarly, the third concept is GNPMP, that is gross national product at market price. So GDP we have already given. We have to convert this domestic value into national value. For that, what is the simplest method I told you? You need to just add net factor income from abroad. So the receipt was 450 crore minus the payments, that is 225 crore. So the net factor income is 225 crore. So add this 225 and 7,000, you will get 7,225 crore as GNPMP. Next is GNPFC, gross national product at factor cost. We have already calculated GNPMP, so 7225 minus indirect taxes, that is 1500, plus the subsidies. So you will get this 5970 as the GNPFC. Next variant is NDPMP, net domestic product at market price. I told you to get net value from gross value, you have to simply deduct depreciation. So depreciation given here is 770 crores. So what is the gross value? Gross value is GDPMP. This is NDPMP. So from gross to net, 7,000 minus depreciation, that is 6,230 crores as NDPMP, net domestic product at market price. Next is NDPFC, that is factor cost. So to get, I told you to get the values at factor cost, you have to simply deduct indirect tax and add subsidies. So NDPMP is 6230 crores minus indirect taxes plus subsidies. So this is the value 4,975 as NDPFC. Next is NNPMP, net national product at market price. So we have already calculated GNPMP, so that is 7225, right here 7225 minus depreciation, so you will get NNPMP as 6,455 crores. And finally the NNPFC, that is net national product at factor cost or national income. So NNPMP we have already calculated, that is 6,455 crores minus indirect taxes 1,500 crore plus subsidies. So NNPFC is 5,200 crores, which is finally the national income. So this way we can calculate different concepts of national income. Now moving on to the next concept, that is per capita income. Per capita income is nothing but it is a measure of amount of money earned per person in a country or in a region. You can calculate for a country, for a state, or for a district also. So per capita income is calculated to determine the standard of living and quality of life of the population of a country, of a state, of a region, or of a city. So you need to calculate per capita income for these two reasons, for a standard of living and for quality of life of the population. So how to calculate this? You can calculate simply by dividing national income with population of the country, or if you want to find out for the state, so divide state income divided by population of the state. So symbolically you can write per capita income is equal to national income divided by the total population of the country. So this is the concept. Next concept is personal income. Personal income is the income from different sources. Compensation from a number of sources, including salaries or wages or bonuses received from employment, or you can earn from self-employment. You can earn dividend by investing in shares and distribution received from investments. You can earn rental income also. So from real estate investment, you can earn profit from your businesses. So personal income includes many components. So what are those components? How we calculate? Personal income is equal to simply national income minus corporate income tax minus undistributed corporate profit, that is UDCP. And then third one is social security contribution, that is PF and all, and plus transfer payment. So from national income you have to deduct these three things. You have to deduct corporate income taxes, have to deduct undistributed corporate profit, and you have to deduct social security contributions which is given by the employees. And then next component is transfer payments, which goes to the people, that is transfer payments. So personal income is calculated with this method. So this is all about the different concepts. Next is finally disposable income, the income at the disposal of the individual to spend. So how to calculate this? Personal income minus personal current taxes equals disposable income. It is the amount of net income a household or an individual has to invest or save or spend after income taxes. So this is the income available at the disposal of the individual or household. So how to calculate? DI, that is disposable income, equal to personal income minus personal taxes. So this is all about different concepts related to national income. Thanks for watching. Don't forget to give your comments and feedback in the comment box. Thank you so much.